Hello, everyone. My name is Colin Brown. I'm with NACVA and the Consultants Training Institute. We want to welcome each of you to Hardball with Hitchner, solid answers to tough questions. A few housekeeping items. First, you can obtain CP credit by answering all the poll questions that are going to pop up on your screen during this session. We're going to play this sound, and that will notify you that a poll has been launched. CP certificates will be available on the nacva.com portal in 3 to 4 weeks after the conference. If you have any questions during today's presentation, you'll be able to submit those questions into the Q&A section of your Zoom toolbar. Please use the Q&A option for relevant questions for our presenters. If you have a generic comment, a technical question, or a poll question, you can use the chat feature for those, as those types of questions will be directed to me. Now it's my pleasure to introduce our presenters for today. First of all, we have Jim Hitchner. He's Managing Director of Financial Valuation Advisors and is President of Financial Consulting Group. He is also CEO of Valuation Products and Services, which created and distributes the Business Valuation Standards Compliance Toolkit, the VPS DLOM Guide and Toolkit, the Hitchner-Pratt-Fishman Consensus View Q&A Guide to Financial Valuation, and presents monthly webinars. Jim is also an accomplished author and instructor, having authored and co-authored many books and presented to over 200 conferences. Then we have Ron Sr. He has alphabet soup after his name, and I don't even know if I could even say all those without messing it up. But he's a managing partner of Senior Gustafson LLP based in Lakewood, Colorado, where he is responsible for financial forensics, business and intellectual property, valuation, practice management, consulting, and exit and succession planning services. And he's also an author of multiple books. Then we have Mark Cusick, who's the founder of Cusick Valuation Group, LLC of Chicago, Illinois. He specializes in business valuation of family-owned and closely held securities for use in estate tax planning, financial statement reporting, estate tax returns, gift tax returns, buy-sell agreements, purchase-sell transactions, ESOPs, and economic damages, matrimonial and shareholder disputes. And finally, we have Chris Hamilton from California. He is a certified public accountant, a certified fraud examiner, and certified valuation analyst, specializing in fraud and forensic accounting in the context of complex civil and criminal litigation. He has served as an expert witness in civil, criminal, probate, and family court matters. His accounting and consulting firm is located in Simi Valley, California, and is regularly retained to lead forensic investigations of fraud, embezzlement, and asset misappropriation. And with that, I will turn it over to, we'll have Jim take over.
Thank you, Colin. And we're here to answer your questions today. Also, there's one main rule. I mean, if you've attended a hardball session before, every time a panelist says it depends, you're allowed to boo. It will be a silent boo, but it is what it is. No, it depends allowed here. These experts will discuss some of the top issues in BV and litigation services. And I'm going to start off with you, Chris. When do you think the virus's impact on value of private companies was known or knowable? I mean, there's already litigation and strategizing going on, at least with the lawyers that I'm talking to, particularly in divorce areas and in the estate and gift tax area, you know, where, hey, the known or knowable and the valuation date could have a huge impact on the value. So what do you think, Chris?
Well, I think it's probably December, January timeframe. I know in January, I was doing certification training in Salt Lake City. And we actually talked about, at the time, we called it the Wuhan virus. Of course, since then, that's not what you're supposed to call it anymore. But that in January is what we were calling it in that class. And we were talking about the impact it would have on cash flow and risk. How knowable the risks were, it was probably later than that. But certainly by mid-January, it was on my radar, and I had clients who were already battening down the hatches. So, you know, I think depending on the industry, people were paying attention to what was going on as it went through China, and then I think it went through Europe a little bit before it got here. So that's when it was on my radar.
Okay, Mark, what do you think?
Well, I think that there's different areas. And I think, Chris, we had talked about this earlier. And in California, wasn't there tracing that was going back to October at some point where they actually thought that there was a virus or something going on that they didn't really identify? It
Yeah,
was affecting
there was illness in Southern California, brutal illness, January, February. And I know my grandkids went to the doctor and the doctor said, it's not the flu. We don't know what it is, but you're really sick.
Yeah, I heard that they were doing that. They didn't know what it was and how it was doing it. But I think that ultimately you might see an impact on your benefit stream at that point. You might have now other places. I think it's sometime in January, late February. Depending on the area and the time and place. I know in Chicago, there was nothing even known or knowable until I would say middle February or so when things were starting to go on. I know that when Trump actually brought it to the forefront by closing down the border, it got a lot of people's attention. And most of the time they were arguing about the fact that he closed the border down more than they were that, there was a reason to. So you take a look at that and that becomes an issue. And then you take a look at the stock markets. And Jim, I think you put out an outstanding timeline that is out there showing the correlation of events and how the stock market, all three different market indices changed and moved. And I think that was somewhere around middle to the end of February when the market started to react as a result of some of these different things. So I think you really have to pay attention on not only the region and where you are, but some of the different locations and what was really happening around the area and take various components into consideration. It comes back down to telling the story, right? And it doesn't mean that we just take this global approach. I think you need to really assess the situation on a case by case basis and deal with the facts and circumstances that we have to deal with.
Okay, I'm going to go all the way around the group here because this is a very important area. Ron?
It's so interesting to me. I think this is the biggest conundrum I've dealt with in business appraisal in the 40 plus years I've been doing this. And when the question is, when is the impact known and knowable? I'm not sure we know yet. I think we knew there was something big cooking. I kind of look at it more in kind of early March when there was a realization that this is a big deal. This is going to impact the economy big time. But I think we're still trying to sort out what the impact will be. And agreeing with both my colleagues, I think it is so highly dependent on geography, number one, and industry, number two, in terms of what are you doing and where are you doing it? Because I think the impact is still yet to be seen in many of the sectors that we deal with as business appraisers.
Yeah, I mean, I've publicly said that I believe it's known or knowable as of February 24th, 2020. And so somebody says, oh, what does that mean? February, if you have a valuation February 23, you don't consider COVID? The answer is yes. You may consider it a little bit, but as Mark said, I tied it into the stock market. And believe it or not, in February, two of the indexes had hit their all-time high. In February, they hit their all-time high. And then, and I'm talking about the Russell 2000 and the Dow Jones and the S&P. The Russell peaked a little earlier. And then February 24th, all the indexes just tanked. And the indexes that tanked were around 2 weeks from their high, all-time high. So, but okay, we have a question that just came in, has something to do with this. So do you inquire if employees were impacted at a company because they traveled, even if their region was not impacted overtly, for example? Anybody want to, Chris, you want to take a stab at that?
Yeah, it's so interesting because of where I live in Southern California. you know, companies were impacted in December, January. There's no question. They just didn't know what it was they were being impacted by. So I don't know. I don't know what the impact of that would be, honestly. Um,
Well, a lot of corporations, people travel like us. I haven't been on an airplane in 5 months.
isn't
And
it great?
in my career, I have flown over 3,000 times.
Yeah.
I mean, I'm not bitch. Oh, can I say that? No, I'm not complaining about it, you know, because, you know, as I got older and the flying became more difficult, not because I was older, it became difficult earlier on. It wasn't the fun days of the 80s where you could switch tickets, you know, with someone else and no one ever checked anything. And so I'm not complaining about not traveling, but, you know, doing a lot more Zooms, and this is one case here. So, okay, here's another question. Oh, we have a, get rid of that. Okay. How are you applying known and knowable to personal injury or wrongful termination cases if the injury occurred December 31st, 2019, but the damage period includes COVID-19? I don't do personal injury or wrongful termination. Does anyone else on this panel do so?
No, but I have active, very active cases. One in particular having to do with the fires that went through Southern California in 2018. And we're in the midst of doing damage calculations. And now all of a sudden we're having to bifurcate how much of that damage right now is due to COVID-19 and how much of it is because of the inability to recover from that fire. So that, you know, personal injury and wrongful termination is a specific application, but it's a general concept that we're all having to deal with now. You know, that is a difficult question. I suppose it's facts and circumstances specific, but there's no question that has complicated damage calculations right now.
Chris, is facts and circumstances a really nice way of saying it depends?
No, sir.
No. Right answer. That's the correct answer. Well, here's one of the things that's come up before is if you let's say you have a divorce and you've got a valuation date, maybe it's a separation date and it's December 31st, 2019, and now the trial's coming up in late August. Do you think a judge gives a damn about what the company was worth December 31st, 2019 without COVID? What's a judge's job? Court of equity, and attempt at being fair. And so how can you be a judge sitting there and be fair and practical, and some appraiser hands you an appraisal? I would look at that if I was a judge, and I think, I don't give a damn about your rules and your known and knowable and the use of subsequent events. I want to know what it's worth right now with the COVID, you know, or what was it worth back then with knowledge of the COVID. And I'm having a lot of discussions with attorneys on this right now. A lot of it, actually, it's not just divorce attorneys. We're dealing with other situations on when to file cases. And Ron, what do you think about that? Do you strictly go by the rule, or are you having discussions with your lawyer saying, do you want me to do this valuation for $30,000, $40,000, $50,000? And the judge is going to say, this isn't helpful.
Yeah, at least in dissolution in Colorado, you know, the standard of value is what's it worth as of the date of permanent orders. So if you're going into a hearing today, you know, the relevant valuation is what's it worth today. And most of what we've done for the last 10, 15 years has always been under the premise of going concern. Now, you know, we may be in the liquidation premise because today, you know, you may be out of business. Your employees may be gone. You may be surviving on a PPP loan. The conundrum, though, is, you know, the judges, they want to keep it simple. So, you know, try to explain to a judge that we've got PPP financing and, you know, we're in this this time warp, and they just get frustrated with us. So, but you know, what's relevant is, you know, I think it's a whole new world for us as business appraisers.
Well, I'm about to put a piece out about how the USPAP and SSVS, AICPA, SSVS allows you to do to break the rule on known or knowable by doing an exception or a hypothetical condition. You're allowed to implement a hypothetical condition. And SSVS has it, and so does USPAP. And so if a lawyer says, well, Jim, you're valuing it as 1231 without COVID, I don't want you to do that. I don't think the judge wants you to do that. Can you do it with COVID? Don't take the standard answer saying, well, I have to do known or knowable as a valuation date. You can put in a hypothetical condition and do it with COVID and do it according to the standards. I have a piece coming out. It's coming out. It's supposed to come out this week. But I got a new computer, and that really, if you remember, every time I get a new computer, I realize why I don't change my computers very often. I mean, I blew a whole day and a half.
Hey, Jim.
Mark, what do you think?
You know, Jim, I think that it's really important.
You know, you're a standards guy. You do a lot of work with standards.
Yeah, and I think that you can always put the exception in, right? And then do it based on your assumptions, limiting conditions, and your exceptions. However, I think it's important to note that with that exception, you're kind of changing the rules. And then it's really up to the trier of fact to really change that date. It's not up to the actual valuation analyst, right? And we can put in all kinds of assumptions and say that's what it's going to be. But unless they alter the entire estate, you have to be careful, right? Because you might say, okay, well, my value of my particular company is going to be less in it because we're going to bring in the covert information as of June when the valuation date might have been December 31st. But then what about the 401k and all the other investment funds that have also changed or altered? You know, they have to be at the same point in time. You can't take yours and adjust your particular company in June and say, I'm going to give you the COVID effect, and then none of the other assets are.
That's a good point.
You know, I think that you got to be able to make sure that everybody's on the same page, and we need to communicate and express our opinion as to what it is that we would like to do and the impact. But I don't think the date is our call. I think the date is going to be that of the trier of fact.
I think, but here's the deal. You can easily say, well, throw it to the lawyers. The lawyers got to figure that. Let's assume it's a divorce. The lawyers got to figure this thing out. You have to deal with the 401k and everything else. It's not us that picks the date.
Right.
It's the lawyers or the law.
The law.
Depending on whether it's regulations or law or case law. So, you know, but if you're in a divorce and one lawyer, it favors them to have Hitchner do December 31st, 2019 without COVID, why would they agree with the other side? I mean, I think the lawyers are going to disagree, and then they're going to have to, hopefully they would go to the judge and say, Judge, you got to rule on this before we all spend a lot of money on something that you're going to later say no to. But I think it's the judge, the trier of fact, and the attorneys. It's not our job. Now, we often have to restrict ourselves to say, we want to help. And then you got to pull back and say, that's not our job. So, all right, we have another question. So do we update engagements if we testify later? Ron?
Do we update engagements if we testify later?
And I think they mean if you did evaluation, no COVID, and now COVID's here.
Yeah, I think so. I think you at least say, you know, if you want this to be relevant for the current date, some things have happened that we think are significant enough that our value, you know, conclusion may have changed. I think it's incumbent upon us to at least, you know, inform whoever's using our work product that, you know, if you're relying on a December 31st opinion, that may not be reliable for what's happening currently.
Okay. Well, let me make a statement here. Do you all agree that if the lawyer tells you to do it without COVID, because COVID wasn't known or knowable as of 12/31/2019, Or if they tell us to do it as of that date, but incorporate COVID-19, does everyone agree that you can do either one? One will be a hypothetical condition and the other one will be straight up. And I think disclosure is a big deal, but does anyone disagree with that comment?
I don't know if I don't know if I disagree, but I think there's been a huge
That sounds like it depends again.
No, this isn't going to be a depends.
Okay.
I think there's been an overreaction to COVID on a number of levels, and not the least of which is in the valuation community. I think you have to make a case that it's a permanent loss in value to start changing reports. And I agree with everything that's been said. You got to let the attorneys make the call. And when they say evaluation date or the losses evaluation date, that's the valuation date. But I think it's when we start talking about doing two different values, we're maybe overreacting to a temporary situation. I really agree with Ron. I don't think we even understand yet what the total impact of all of this is. So we have to operate off of what we do know. And to say that the business has no value today would make an assumption that it's never going to come back. And there are some businesses that's absolutely true. There's no question. And in an equity court, a business that had great value at December 31 and isn't worth anything today because of COVID, I think you have to make the case that's permanent, and then you're good. But I'm just throwing a little different perspective on that question in terms of the permanence in loss of value.
Yeah, in my neighborhood, believe it or not, someone built a movie theater. They just built a movie theater, but guess what? It's not open.
Yep.
What a bad time to build a brand new movie. It's one of these restaurant movie theaters with a bar and so on. We just got liquor license, pouring licenses in my town. And then another place opened up a bar, but no one's allowed inside. And you can sit outside, but it was really built to be inside. And beautiful bar. And well, I'm pretty sad because I can walk to it. No.
Too bad it wasn't a drive-in theater.
No, yeah, really. Okay. Here's a comment. I agree with the comments, but using the market indexes that you just referenced, I believe as of yesterday, Dow was within 2% of a complete recovery of the February high. That's true. Therefore, the next question is what the potential adjustment for known and knowable circumstances? And he mentions Grabowski's suggested, well, not suggested, but he's they're adding 1% to their recommended equity risk premium. Yeah, I mean, some businesses are going to, this will be interesting. What about if some industries have rebounded?
Yeah, can I take
that? And you know that now. Why doesn't that come into the hypothetical condition, right?
Hitch, can I comment on this for a minute? One of the things that I think people really need to do is to go back to some basics and actually look at what's happening within that companies and their benefit streams. Everybody talks about doom and gloom. There's some companies that are flourishing underneath this particular situation. It's not always negative, right? You got some sanitary companies that are just doing an incredible amount of work and jobs that are the opposite way, and they're spiking as a result. So, ultimately, we keep saying all this doom and gloom about all these. You got to take it company by company and benefit stream by benefit stream and understand what's happening within those particular areas. I have a company, for example, it's an import-export company, and they get a lot of their inventory from overseas. And right now, we got to take a look at the burn rate on this because they can't get inventory. They had $10 million worth of inventory on the books. They've been selling a lot of product online. But once that $10 million of inventory disappears, guess what happens to their working capital, right? So now as they deplete that working capital, that's going to go in when you sell the inventory, that goes into receivables turns into cash. That only goes for a certain period of time until such time that the inventory runs out, right? So even if they had normal sales and normal volume going through this entire time, that's because they had the inventory. And then when you had the lull, a lot of people actually had a surge because a lot of people bought home office equipment and all those kind of furnitures in the month of May. And they were stockpiling all that up. So he actually had a spike. but that was short-lived as well because all of his other inventories are on barges in the middle of the ocean. And China shut down, and there's no way they're going to get it back. And they're estimating that not only are they going to have to deal with the fact that inventory is not coming into play, it's going to take over a year to be able to restock and resupply. So now the question is, look at your cash flow. And Rod had talked about going concern. If they can't get the capital back to be able to restock, and they burn through all that cash and capital, are they going to be able to replenish inventory to be able to come back? That's a whole nother question.
I mean, in your situation, there's another potential problem. A lot of corporations, including the big cities like New York, they want to get out of their leases.
Yeah.
Those that have successfully converted to work at home. And guess what that's going to cause? A glut of used furniture, a huge glut if that takes, I mean, there's ripple effects all over the place.
All over.
So the comment here about subsequent events on financials, we have subsequent events in valuation too. There's a toolkit from the AICPA on that. And there's a comment here, some businesses have been helped by COVID. I think most of our discussion today is dealing with those industries and companies that have been negatively affected. And of course, there are companies that have been positively affected as well. Okay, here's another question. Is there an election risk factor that you would consider, i.e. a difference between before presidential election or after the presidential election? What do you think, Ron?
Well, oh God, I so want to say the word that you said I can't say. I'm not dead. It almost slipped out.
Facts and
Certain
circumstances.
industries will be impacted differently by whoever wins the election. There are a lot of ballot issues. I think, as some of you know, I do a lot of work in the cannabis sector, and there's a whole lot of stuff happening right now that are dependent upon what happens in the November election that will be good or bad for certain businesses. And I want to go back to a comment that kind of builds on the last question. There's a lot of clients that we've seen that have been working off a kind of a pipeline of work, law firms and construction companies that had work in the pipeline when this came, when COVID kind of hit. And now that pipeline's kind of running out. The work in process, is running out. And the new jobs on the horizon are kind of skinny for some of those law firms and some of those construction companies. So the impact of COVID is just starting to hit where they've been going, they've been keeping people employed and being busy, but now all of a sudden there aren't new projects coming out of the ground right now, and there's not new money coming into the stream. So it's kind of fascinating to see how. And I think that's why, like the paycheck protection loans, they changed the criteria from 8 weeks to 24 weeks, because all of a sudden, at the beginning, it was all geared towards hospitality and keeping those people employed. Now it's like, the people that are just now starting to realize the impact of COVID.
Okay. There's another question. Trying Jim's idea, you will have to reach an answer based upon sufficient relevant data. Of course, I mean, I can't argue with that. Next one, to Chris Hamilton, we need a working paper on COVID-19 loss value. So I'm not sure that, I don't know if there's an answer to that. Here's a comment. As to inventory, see announcement from Clorox yesterday. Inventory dependent upon raw materials used in PPE, so no ability to make the wipes, and estimate sometime in 2021 to recover. My opinion on that is use Lysol wipes. But it's true. I mean, Clorox can't meet the demand for, until at least 6-7 months. Does anyone have any comment on that?
Well, I think the long-term impact of this thing, I saw that Google has told their employees they're not coming back to work for another year. I mean, you just start thinking about the ramifications of all of that. And yeah, I'm just going to go back to what Ron said. Well, we still don't know where this thing's going.
I did
Okay,
see
and what
something
the-
just recently that the distilleries that had all switched to producing hand sanitizer are now kind of switching back because Purell has now been catching up with the ability to produce enough hand sanitizer to satisfy the market.
Yeah, the supply demand chains are changing. And as you do that, same thing with the masks. Remember the masks were selling for enormous amounts of money, and now you can buy 100 of them for, $20. So ultimately it's a matter of understanding the supply and demand curve always levels that playing field out, and we have to deal with it. But no different than the Clorox supply chain. I think all companies have a supply chain issue, right? Just like the furniture company we're dealing with, it's the same kind of denominator for all companies. It's just different types of materials. And I don't care what you build or how you build it or where it is, you have to now analyze the supply chains. You have to determine what those supply chains are going to cost you and what your margins are going to change to, because now you have no idea what that cost of replenishing that supply chain is going to be based on the scarcity of the market. And
Well,
then, how does that change your margins, right?
Yeah, we also have to remember this is global. This isn't
Yeah.
Republicans and Democrats or whatever. This is all over the globe. Supply chains have been completely disrupted. Some of those supply chains aren't coming back anytime soon.
No.
And in my view, the move to bring manufacturing back to the United States just got injected with all kinds of steroids. It's going to happen in a big way, but it is not going to be a smooth transition.
The other thing, Chris, the other thing, you guys, that people aren't talking about here is the customer list, right? And how many of the customers aren't going to survive that were there before, ultimately hitting a jab to that benefit stream going forward. All of a sudden you take a look, we went through the customer list in severe detail, and we went through it with the attorney and the owner of the company line by line. And we determined that 25% of his customer base isn't going to make it. And automatically we did a DCF model, and you had to reduce that benefit stream going forward. They're just not going to be there.
I mean, think about all the suppliers to restaurants. They got to be dying, I mean, and there is a ripple effect everywhere. One of the comments is it's not just a small company issue. I think small companies are definitely more likely to have problems, but big companies are having problems too.
Yeah.
And another question or a comment: economy is huge lagging indicator as operational cycles are yet to be fully impacted in many areas, and unemployment continues to rise and will likely see. That's a good comment. All right, guys, let's switch gears and talk about discount rates. I mean, I'll share that Mercer said he's adding 1%. Another guy at Mercer Capital said he's adding between 1.5% and 2%. At least he had an example pre-COVID, after COVID. Duff and Phelps is increasing their ERP, equity risk premium. Mercer didn't say where he's adding the 1%. So I'll start with you, Ron. What are you doing on discount rates, COVID-wise?
I'm fascinated.
If anything.
All the big dogs can say just add 1% and move on and pick it up in the cash flow. I do think that, there's a numerator and denominator to most of what we do, particularly in an income method. In most of the adjustments we will make will be in the cash flow. But I also think that, industry and unsystematic risk are big wild cards today, and whether it's 1% or more, I'm inclined to think that you can make bigger additions in particular industries that are more adversely affected by this than others. How much? That's the question.
All right, Chris, let's go around this one. There's a lot of thoughts and concerns about discount rates. What are you doing in terms of equity discount rates?
Well, I tend to be
with the build-up model right now.
Yeah, I tend to be an optimist, and I don't see anything going on right now that I view as detrimental on a permanent basis. And when now everyone you mentioned who's raising their risk rates by 1% are infinitely smarter than me, so it makes me wonder. But I just see this as a temporary issue, and when I see a temporary issue, I'm going to adjust the numerator, the benefit stream. I think it forces me into a DCF in every case, because the short-term prospect is uncertain. But when you lock in a premium of 1%, you're locking that in, as you like to say, Jim, for a very long time. That's and so I'm going to be really interested to see what the equity risk premium, the historical equity risk premium from 1923 through or 1926 through 2020 is. And I'm going to bet, I would bet a lot that it's not going to change much. Maybe a tenth of a point. And
Yeah, I would agree with that based on the historical numbers. But remember, we have to remember that the historical numbers are to be used to help us predict the future.
yes,
Although most of us just tend to take it, whatever it is, it is. I mean,
Well, you're
right
right.
now, I'm putting there are exceptions to everything. I'm putting 1 to 2% in the company specific risk. I'm not raising the equity risk premium because I've never done that before, and I'm not going to start. And you're going to get attacked on the company specific risk no matter what the hell you do. So throw it in there and, and make it part of that. You're going to have to explain it, but you got to explain the company specific risk anyway. But we're doing the same thing when we're into the probabilistic scenario analyses. And the other thing I've been saying is, you hear about DCFs. You can't do capitalized cash flow. You got to do DCFs. Well, you can do a 2-year DCF or a 3-year DCF. 2020 is, oh my gosh, we're trying to survive. 2021, we get through it, or 2022, we get through it, and then you have your terminal year. So you don't have to do a 5 to 10 year projection to do evaluation. Do a 3-year. And I've done presentations I've seen some people doing the probabilities and like 15% probability. I said, what are you, out of your mind? I like 50%, 50%, 50%. We don't have a second wave, and 50% we do. And that's how I'm doing it. And sometimes I'll do 3 scenarios, but the base case is going to be 50%. The worst case is going to be 25%. And the best case is going to be 25%. Because I don't think anyone in terms of probabilities can do any better than 50-50 or 50-25-25, and work your projections around that. And I think it's very hard to attack 50-50 and 50-25-25. Whereas if you have, 40% and 20, 25% and 35, I mean, it gets crazy. No one's that good. So, all right, we have another question or comment. Got a lot of comments. Keep them coming in, please. With regards to the discussion on impact of COVID, we are clearly in a state of uncertainty. Therefore, besides adjusting cash flow benefit streams, should we adjust discount cap rates? If so, wouldn't we need to adjust the discount rate for a few years and then adjust after a few years, assuming we get back to normal? I've never used multi-period discount rate, different discount rates. But I am thinking about it now. I am thinking about it, for those of you to do a lot of litigation work, once you do something once, okay, it comes back at you, no matter how many times you don't do it.
Jim, I'll take this if you'd like.
Go ahead. What do you think, Mark?
I'm in this range of the 1, 2, 3 year DCF model. And I do my historical to get my base year to find out how big or how far I've fallen or risen based on what's happening to that process in my margins and how far I'm off my margins based on that base year. And then the question is, in discussions with management, how long is it going to take us to get back to normal, or what that is? So the first year in 2020, my cap rates are a little bit higher in the company specific risk. I don't adjust the equity risk premium because I agree with Chris. This is not a long-term thing. It might be a going concern issue or something, but other than that, I think that it's going to be, at some point in time, a new normal, whatever that new normal is. And that will be in the terminal value. And that might be a year, 2 years, maybe 3 years out. And whenever you decide, based on all the communications with management on where they believe everything is going and what they're being told within their industry, they're getting some good insight as to to how far this is going to go out. I don't usually go out any more than 3 years, but I think that terminal value and that rate that we have in the terminal value is some kind of new normal rate. It's not something that's going to have this impact going forward. It's going to have something that looks like whatever this is going to be going forward. And we look at it as what this is going to look like. And that might have some probability analysis to it. But ultimately, you know, I know that today, whatever's going on today is probably not going to be predicted of the future, right? So that gives me a higher rate than I would than tomorrow or the next year, and then maybe the terminal year.
Okay. How has COVID-19 affected discounts for lack of marketability? Let's start with minority, and then let's go to 100% control. Ron, you want to grab that one? Why don't you do the minority one?
Has COVID
Increased the
affected
DLOM.
discount for marketability and a minority interest? I would say yes. Trying to avoid the bad word. We're in a period like we've never seen before, and when you're trying to figure out what someone will pay for a minority interest in a closely held business in a particular industry, I think many of those hypothetical buyers are going to say, I need a bigger discount because of the uncertainty. Now that could be factored into the discounted price through whatever approach you're using, but I think it also could be factored in with a higher required discount for marketability for that minority interest in a business. In uncertain terms.
I asked the question, a minority interest in a closely held company is very hard to sell. It can sell, but it's very hard to sell. Is it any harder now? And if the answer is no, I don't think there's a change. If the answer is yes, because COVID's made a minority interest even harder to sell, then you know, maybe you need to bump it up. What do you think, Chris?
A lot of what I'm seeing in literature, you know, like bumping risk rates, when you really read it and listen to what they're saying is it's harder to sell business right now. And
A whole business.
or a non-control interest. I think the short answer is yes. Marketability discounts are up for both elements of that question. But again, it goes back to, we're in the business of persuasive communication, and there's three ways to adjust the value for various variables. One is the benefit stream, the second is the risk rate, the third is a discount. And I think it's an easy story to tell that it's harder to sell a business in this environment, depending on the industry, of course. Let's talk about a hotel. It's harder to sell a hotel right now. There's no question about it. Is that value going to come back? You know, I think it will, but I think there is a hit on the price right now. You can sell your hotel, but you're going to have to discount it. Is it because of future cash flows? Is it because of risk? Or is it because it's just really hard to sell a hotel right now? And I think you can make the case that it is a marketability discount.
Okay. Mark, how do you, what are you doing with Escorps right now? Value in Escorps, are you adding any Escort premium? Number one, I assume you're tax affected. I think all of us are tax affected in some way or form. But let's take that off the table. But are you using any of the models that add an Escort premium? And the conundrum that our profession has is the Fannin model and the Traherne model show a no Escort premium. In fact, they're showing a SCorp premium. Whereas the Delaware MRI and the Van Vliet Scene model are still showing an Escort premium. I mean, the other day I was writing something, and then I had something about Escorps, and I actually built a model, and then I built quickly built a Delaware MRI model, and under various scenarios. And then I stared at the screen for 45 minutes, and I said, something's wrong, and I'm going to find it. But 45 minutes of non-billable time, I need to get back. But it's, something's wrong with the Delaware MRI, and I haven't figured it out yet. But I got this bit. I actually sat and looked at. I'm such a nerd. Looked at a spreadsheet for 45 minutes. Said something's wrong, and I'll find it. But I'm sorry, Mark. Go ahead.
Yeah, no, I am not putting any premiums on, and there's two various reasons why. I once had a nice, what I thought was a nice flight back from Minnesota with Van Fleet. I'm sure he didn't think it was as nice because I talked to him for an hour and a half on the flight all the way back about his model that he just presented on. And ultimately it came down to, you know, the double taxation on the dividend issue, right? And a lot of the small companies that I have, there is no dividend that they've been issuing, and there's not a lot of that excessive comp. So how much of that double taxation? Then you have the fact that the C corporation rates have been lowered, and then you got that whole situation to deal with, right? So I don't really believe that I've come up with it. And when you look at some of those models, you are getting some negatives. So I have not been using premiums for the Escorts.
Yeah, I mean, if you look at the tax rates, that's another issue that's out there. I mean, which state taxes, and local taxes, the federal rates around 26, 27, depends on which state you're in. But you can get individual rates at the high level up to 45%.
Yeah.
There's a huge difference. So how the hell can an Escort be worth more than a C Corp if the tax is so high?
Right.
Regardless. So that's kind of troubling to me as well. And you remember the Fannin model and the Traherne model required that you start with individual tax rates. And that's why those models blew up under the new TCJA. But I don't understand why Delaware MRI and Van Vliet hasn't blown up. Now, Van Vliet's Escort premium is now down around 5% because of sunset provisions coming up, where all this, so it's going to, so in a few years, no one's going to be applying anything, assuming the sunset provisions take place. And, but right, I'm not using an Escort. I have never believed in an Escort premium. Have I applied one? Yeah, because some lawyers said, can you do it both ways, with and without? And I said, yeah, but I think the right number is without. But I can be convinced to show something two ways. But anyone else, any thoughts? Chris?
I'm with you. I've never used a premium, and I'm definitely don't see one now.
Okay.
Yeah, I'll just add to that most all of these models were developed pre-TCJA, and I think when, you know, corporate rates got flipped down from individual rates, I think it threw the models all into question. And we'll end on this question: the market approach, guideline company transactions, and public company method. Mark, how are you dealing with COVID and transactions and COVID and the market of public companies?
Yeah, I don't think you're even going to get transaction data in 2020. And anything prior to that, I don't see how it's relevant to what's happening today. You know, you might be able to use that information if, in fact, the date was prior COVID. Then you're right back to normal conditions, I guess, with some of that. But I have a hard time with some of that market data transactions to begin with in normal situations.
Sure. Yeah.
And, you know, it's more of a sanity check to me than it is anything else on what I'm dealing with, specific information for the companies that I deal with from the income approach. Now you throw in COVID and it's like, you know, good luck.
It's made a bad method worse.
Yeah.
What I'm talking about, I think what you're talking about, private buyer, private seller.
Right.
You have a public buyer or a public seller, that's a different ballgame.
Different game. Right.
Yeah, definitely. All right, we're going to take the last question here. Are you starting to adjust your tax rate in your DCF in future years, expecting that tax rates will rise to pay for COVID? Wow, that's a good question.
Really?
My answer is no. Ron, what do you think?
Well, I was just starting to say that what tax rates you're going to use kind of ties into the election issue, because, you know, the tax rates may rise, and they could rise significantly if, you know, if the Democrats, and I'm not saying that's right or wrong, but, you know, that's what tax rates do you use? right now, current tax rates, so you know they're going to change. And part of this is just the reality of the venues that we most often have to sell our opinions to don't want us to speculate on what future tax rates will be. Use current tax rates until
That's
you
what
know
I
they're
do
gonna
as
change,
well.
because
Current
it's
tax
too
rate.
hard to sell that, that we're going to predict that tax rates are going to change, because we just
But
don't.
one thing though, is, hey, it is hard to do that, but what's the average annual deficit? About $1 trillion? What's it this year already going to be? 4 trillion, 5 trillion? I mean, my gosh, people are talking about, oh my, a $1 trillion deficit. Well, all this money going out. I don't know the net on that, but it can't be good. It can't be good. Colin, I think we're at the end here. Thank you, Ron. Thank you, Chris. Thank you, Jim. Thank you, Mark. And I'm sorry, Ron and Colin. And if you want to take over, Colin, that'll be great.
Thank you very much. This was an awesome panel. I really enjoy that there's, this is an unscripted panel. It's awesome. So anyway, we are done for the day, and we will see everybody in the morning. Have a great one.